Uncomfortable distinction concentration risk can hide behind patriotism just as easily as behind ignorance. One of the first insights global investing books offer is that economies move at different speeds in different directions for different reasons. While one country wrestles with aging demographics, another benefits from a young workforce. While one central bank tightens aggressively, another stimulates cautiously. Growth, stagnation, inflation, and innovation are unevenly distributed across the world. Ignoring this reality does not simplify investing. It distorts it. Books that open readers to international markets emphasize that diversification is not merely about holding many assets. It is about holding uncorrelated assets. Global exposure reduces dependence on a single political system, a single currency, or a single economic narrative. This is not about chasing higher returns everywhere. It is about reducing the probability that one local shock defines your entire financial future. Another recurring theme is that global investing forces humility. Domestic markets encourage overconfidence. People feel they understand what they see every day. Global markets confront investors with unfamiliar accounting standards, cultural norms, regulatory frameworks, and political risks. Books stress that this discomfort is not a disadvantage. It is a warning signal that encourages deeper research and more cautious position sizing. These books also challenge the assumption that global investing is inherently riskier. In reality, risk depends on price structure and exposure, not geography alone. Some emerging markets offer stronger balance sheets than developed ones. Some developed markets carry demographic or debt burdens that are underappreciated. Global investing books train readers to look past labels and evaluate fundamentals where they actually reside. Another important lesson concerns currency. Domestic investors often forget that currency is an asset and a risk. Global investing makes this impossible to ignore. Exchange rates amplify or dampen returns. Books explain how currency exposure can protect purchasing power over time or quietly erode it. Understanding currency risk transforms how investors think about real returns. Global investing literature also emphasizes history. Markets that dominate one era often underperform in the next. Empires rise and fade. Capital rotates. Books tracing international markets across decades show that leadership is temporary. Investors who anchor expectations to recent dominance miss this cyclical reality. Global exposure acknowledges that the future rarely mirrors the recent past. Another recurring insight is that global investing expands opportunity sets psychologically. Investors stop asking, "What can I buy?" and start asking, "Where is value being created?" This shift matters. It encourages learning. It reduces home country bias. It reframes investing as participation in global progress rather than loyalty to familiar symbols. These books also highlight the role of institutions. Legal systems, property rights, transparency, and governance matter enormously. Global investing is not naive optimism. It is selective engagement. Books emphasize filtering markets based on rule of law, capital controls, and investor protections. Not every opportunity is investable, and discernment is the true edge. Another lesson concerns patience. Global investing often rewards long horizons. Information travels unevenly. Mispricings persist longer. Narratives change slowly. Books caution against treating global markets as short-term trades driven by headlines. Those who succeeded internationally often did so by understanding local context deeply and waiting while others dismissed what they didn't understand. Global investing books also explore cultural bias. Investors assume that their own norms are universal. They are not. Consumer behavior, corporate governance, and labor relations differ widely. Books stress that respecting these differences leads to better analysis than forcing foreign markets into domestic frameworks. curiosity replaces judgment. Another recurring theme is that global investing improves domestic decision-making. Exposure to multiple systems highlights strengths and weaknesses at home. Investors become less reactive to local politics and media cycles. Perspective calms emotion. This emotional stability often improves performance even in domestic holdings. Importantly, these books reject the fantasy that global investing requires constant travel or complexity. Modern vehicles, funds, partnerships, multinational companies allow exposure without micromanagement. The challenge is not access, it is understanding. Global investing is intellectual expansion before it is logistical expansion. Books also emphasize that global investing reframes risk events. A crisis in one region becomes context rather than catastrophe. Capital can shift. Balance returns. Resilience increases. This does not eliminate losses, but it reduces existential exposure. Another subtle insight emerges around identity. Investors who think globally often detach from national narratives about markets. They stop assuming their country must win for them to succeed. This detachment improves judgment. Wealth becomes less political and more pragmatic. As readers move deeper into global investing, literature, curiosity replaces fear. Maps replace charts. History replaces headlines. Markets feel interconnected rather than isolated. Complexity becomes navigable rather than overwhelming. And this is where the story begins to narrow. Because once investors understand that global markets are not distant abstractions, but interconnected expressions of human behavior, policy, and progress, investing itself changes. Decisions become broader. Assumptions become softer. Risk becomes more distributed. And the world stops feeling like a collection of foreign markets and starts feeling like a single dynamic system where capital flows toward value wherever it emerges, rewarding those willing to look beyond borders and learn patiently. Like learning to see capital as something that moves through systems rather than sits inside borders. And this is where books on global investing become most transformative in how they reshape judgment. In the second half of these works, authors shift from geography to behavior. They make it clear that global investing is not about predicting which country will outperform next. It is about positioning yourself so that no single country needs to. This reframing alone dissolves much of the anxiety investors carry without realizing it. The goal stops being national winners and becomes systemic resilience. One of the strongest lessons repeated across global investing books is that concentration is the hidden tax of familiarity. Investors who stay domestic often believe they are being conservative. In reality, they are betting heavily on one political system, one currency, one demographic trajectory, and one set of policy decisions. Global investing exposes this fragility. It does not remove risk, it redistributes it. These books also emphasize that international diversification changes how losses feel. When downturns hit one region, capital elsewhere often behaves differently. Volatility becomes contextual rather than catastrophic. This psychological shift matters more than most realize. Investors who panic less make fewer irreversible mistakes. Global exposure stabilizes not just portfolios, but behavior. Another key insight is that global investing teaches patience by force. Information asymmetry persists longer across borders. Narratives lag reality. Markets stay misunderstood longer than domestic ones. Books show that this delay is not a flaw, it is the source of opportunity. Value often exists where understanding has not yet arrived. Those willing to learn slowly are rewarded disproportionately. Currency reappears here not as a technical detail, but as a philosophical lesson. Domestic investors tend to assume money itself is stable. Global investing breaks that illusion. It reveals that purchasing power, not nominal returns, is what matters. Over long horizons, exposure to multiple currencies acts as insurance against policy error and monetary excess. This realization permanently changes how investors think about safety. Another recurring theme is humility toward prediction. Global markets humble even the most confident analysts. Political surprises, regulatory shifts, and cultural nuances defy neat models. Books argue that this uncertainty is not something to eliminate, but something to design around. Position sizing, diversification, and patience replace conviction-based bets. Structure outperforms foresight. These books also show how global investing reshapes opportunity recognition. Investors stop anchoring on familiar brands and start noticing supply chains, demographic trends, and capital flows. They see how growth in one region benefits companies in another. The world becomes interconnected rather than fragmented. This systems-level thinking improves decisions everywhere, not just internationally. Another powerful insight is that global investing reduces emotional nationalism. When wealth is tied exclusively to one country, political events feel existential. Global exposure softens this attachment. Investors become observers rather than participants in national drama. This emotional distance protects judgment during volatile periods. Importantly, global investing books emphasize that success does not require encyclopedic knowledge of every market. It requires knowing what not to assume, respecting differences, avoiding shortcuts, accepting that some markets are uninvestable despite attractive numbers. Discipline here is as important as curiosity. As these books reach their conclusions, a clear pattern emerges. Investors who think globally are less surprised by change. They expect leadership to rotate. They expect cycles to diverge. They expect progress to appear unevenly. This expectation does not make them pessimistic. It makes them prepared. And this is where the lesson resolves. Global investing does not make the world simpler. It makes your exposure to it more honest. It replaces hidden concentration with visible diversification. It turns uncertainty from an enemy into a design constraint. And it allows capital to follow value wherever it emerges, rather than where comfort insists it should stay. If this reflection resonated with you, pause and ask yourself one question. If your home market underperformed for the next decade, would your financial future stall or adapt? That answer reveals how global your thinking truly is. Share what this made you reconsider. And if you want to continue exploring books that expand perspective rather than promise certainty, subscribe and stay connected. Because in a world that grows more interconnected each year, the greatest investment edge is not speed or prediction, it is perspective.